Hi, everyone. Thank you very much for joining us this evening for the webinar. We'll just give another maybe 30 to 45 seconds for people to just join in. I know everybody is kind of finishing their day. And we also have people live on YouTube. So just bear with us maybe for another 30 seconds. Okay, great. Maybe we will kick this off. Thanks everyone again for joining today. I'm Nandini. I'm the Deputy CEO at Stashaway. And today we are going to be talking about what you can do with your savings and how can we help our cash and your cash get to its true potential. We know markets have been quite volatile. But that doesn't mean that leaving the money in the savings account is our only option. So there is two parts to the program today. First, I'll just take us through a little bit of information around cash management. And in the second part, we very kindly we have Toche and Bertram Sarmago who have joined us from Lion Global and Nikko Asset Management. So Toche is the head of fixed income and multi-asset solutions at Lion Global, one of the asset managers whose portfolios we utilize in our cash management portfolios, as well as similarly, Bertram joins us from Nikko Asset Management, where he is the investment director and portfolio management. And again, we use some of Nikko's funds as part of our Simple Plus portfolio, and we'll share a bit about that. So let me maybe start off by first, if you just want to join the Slido very quickly, or feel free to share also in the comments over here. But where are you currently investing your excess cash? Just allows us later on to look at a little bit of information so that I can make sure that I ask Tochi and Bertram questions that can be even more helpful to you. Just a bit of housekeeping. At any point of time, if you want to drop in the questions, you can leave it. If you are joining us with Zoom, you can leave it in the Q&A button in the space. And if you're joining us from YouTube, I believe you can leave us in the chat on YouTube. Great. So for those who don't know us very well, I'll just go walk through a very quick introduction of Stashaway, but then really look at what are your cash options in the current environment, and then we'll spend most of our time actually getting to know a bit more what is happening and what can we, what information actually would help us make some decisions, and we'll make sure to keep some time for Q&A as well. So our Stashaway, very simply, what we consider our job is to make investing simple and cost-effective for everyone. We are today live and regulated in 5 countries. So Singapore is our home base, but we are also present in Malaysia, Hong Kong, Thailand, and Dubai. We've been recognized for the work that we've been doing, both by our clients as well as by industry. And obviously, we feel incredibly lucky to be backed by some really amazing and world standard venture capitalists who have believed in what we have been trying to build over the last 7 years. So having said that, what we are as a platform is really, as I said, to make investing simple and cost effective. And we do that through a few key pillars. We have our core portfolios, which are globally diversified portfolios, whether you are looking for growth or income, or you're looking to build the portfolios yourself. Cash management, which we are going to go deeper into today. And then we also offer people to be able to invest in major trends as well as alternatives. But today we are really going to talk about cash management, and we're going to talk about cash management largely in the context of Singapore dollar and thinking about, the needs of immediate cash, keeping liquidity, as well as cash that we might be needing for some more short-term goals. Why we feel very strongly about educating people on how to manage their cash well. Because in Singapore, the average household holds an over $88,000 in their bank deposit. And this is mainly kept in low yield generating accounts. This is an incredible amount of money. And as you can see, in comparison to a lot of the leading, mature markets, investors, Singaporeans tend to keep a higher amount in cash. And so, whether we might think of it on a short-term basis, but as this cash stays, over multiple years, it is really important to make sure that it is being managed well. Even if it is not meant for long-term investments, but even in the short term, that this cash is managed well for very simple reason that, because we allocate a very large percentage to cash. So on an average, this is actually 20% of the net worth of Singaporeans, whereas an average high net worth actually keeps only 9% in cash, which means just overall, they are, making their portfolio more efficient. Obviously, the job over here is not to say, don't keep that much cash. We should keep cash what we really need for what makes us, feel secure, what makes us feel that we have enough of a cushion. But rather than, telling you reduce your allocation to cash, the more important thing is today, let's just make sure that that cash is put in the right places to grow. And therefore, we always advocate for a few very simple golden rules of cash allocation. The first one being, you need to always think about your immediate expenses and always ensure that you have 1 to 2 months worth of your expenses at hand, probably in your bank account so that you can get to them really quickly. And also it serves all of your, gyro payments and all. The second is make sure that you build a clear emergency fund. And this, based on your own financial status, based on your dependents, the needs that you may have, it may vary from 6 to 12 months worth of your expenses. If you're young, you don't have any dependents as yet. Obviously, 6 months can be a really good cushion. Obviously, as we have children, we have other responsibilities. 12 months usually tends to be more, where people with kids or people with other dependents may be more comfortable with. But what is really important is that this cash that is really meant for you can reach into it easily. It should remain liquid. It should remain in low risk so that you are not having to deal with a lot of volatility in it, and keeping your peace of mind is really important. But it needs to be beating inflation from an interest perspective. Otherwise, over 5, 10, 15, 20 years that we are managing this cash allocation, it just continues to deteriorate rather than at least keeping up with inflation. And this is why, paying a little bit of attention to how our cash is managed is really important. So if I can request people to quickly answer what is the most important feature in a cash management solution for you. Leave this up for another 5 seconds. Okay. So I quickly want to take us through what our current cash management solutions are, and here you will see how both Line Global and Nikko AM fit, so that you can also understand the context around the the fireside chat later on. Um, so our first cash management product is simple. The name is just that. The product is very simple. It has an ultra low risk because, as you can see, it is largely it's fully invested in money market funds and enhanced liquidity fund. Um, which means that what we prioritize over here is the lowest level of risk that we can actually utilize to deliver the best risk-adjusted returns. There has been no drawdown on it since our inception in 2019 on a weekly basis. We track its performance on a weekly basis. And the liquidity is managed on a 1 to 2 business day basis. So again, something, that you want to put that you don't need for your gyro payments and all in the 1 to 2 months expenses, but anything excess of that where you don't want to see volatility. And we'll talk about this later on. Tuchke will share why we don't see the volatility in this product, but it is really meant for liquidity and ultra low risk. As you can see, these have been the month-by-month returns. Please remember, this is currently the last 24 months have been a high interest rate environment. But again, our projected rate is always, because we manage it on a week-by-week basis to give guidance to our clients, we stay very, very close in our projected rate to what actually is delivered within the product. The next one is Simple Plus. Now, it's just like Simple, but a little bit added on, which means that it has a little bit of short duration bond exposure. And again, we'll go through what does that really mean. But this is while the bonds add a little bit of volatility to the product, which is where, the projected rate, slightly higher projected rate of 3.6 versus what you saw of 3.1 in Simple comes from. But there is a mark to market in this because of the bonds. And this is why, as you can see, it's represented in there has been a past max drawdown, and that has been at the height at 0.82%. Extremely liquid product, but because of the addition of bonds and a little bit of volatility, the guidance from our end is this is really meant for money that you don't need in the next 12 months. So think about your, maybe splitting your emergency fund into it, some part in Simple, some part in Simple Plus, or looking at a couple of other short-term goals that are, within the next 1 to 2 year time frame. This is where you can actually take advantage of, a higher yield that bonds would usually give you beyond money market funds. Again, it stays very liquid, about 2 to 3 business days for you to receive your money in your bank account. And this is all the liquidity is tied to the underlying investments, right? We have to sell the bonds to provide you back your capital. And with that slightly higher risk, which comes from the addition of short duration bond funds, as you can see, the performance, is a little bit better. There's a little bit of volatility in the performance as well, as you can see. And over the last 12 months, this has delivered 4.4% on an average. Now, the third product is Simple Guaranteed, which is, the underlying are actually fixed deposits in MES licensed bank. And this is where for the guarantee, we give up a little bit on returns. So, 2.2 to 2.45% based on the tenor. And the risk that we take over here is essentially a bank risk. Last, we are not going to touch upon this a lot today, but we also provide USD cash yield. So, if you have USD that you're keeping in your bank account. Again, don't leave it to lose to inflation. This is, invested in ultra short duration US Treasury bills. And right now, the guidance on this is 4.3% projected rate per annum. Again, remains ultra low risk because it's the US Treasury and a great liquidity profile of 1 to 2 business days. We use an ETF which is traded on the London Stock Exchange. So again, we optimize for you the performance of the underlying ETF, and that's why we choose the London one in this case for tax reasons. Now, these are StashAway provided products. What are other things that are available for you in the market? And the first one is savings account, which really is something where we say don't leave too much of your money in it because the base rate is 0.05%. And after that, based on a whole lot of things like whether you have a mortgage, whether you have investments with the bank, whether you have insurance with the bank, there are just a lot of conditions for you to earn higher. And we always recommend to not mix investments with other profiles because you want to keep them separate to be able to make independent decisions. There are T-bills. I believe the last auction price was 2.8%, but again, you need to manage through an auction process. Similarly, SGS bonds, SG saving bonds, and other fixed deposit in banks where again there are a lot of rules which are based on promotions, which are based on tenors, minimums. And this is where I think the value that we try to provide is to have a simple product. But again, I think a lot of people in Singapore are familiar, especially with the T-bills and the SG savings bonds. And as you can see today in the environment, all of the interest rates have actually been coming down. And with that, I will finish our presentation part for cash management, and I'd like to invite Tochie and Bertram to the fireside chat. And if Tochie and Bertram, if you could take 1 minute to introduce yourself as well and what you do, that would be great for the audience.
Right. I'll start first. So first of all, thank you, StashAway, for inviting us to your webinar. Always very happy to be part of this exercise. My name is Tochie. I'm with Lion Global. Lion Global is part of the OCBC group. We do manage quite a bit of money from our insurance company, Great Eastern. And by virtue of that, we do a lot of Sing dollar products. And because insurance company tends to have very long dated liabilities, we do buy a lot of Sing dollar bonds. I think the product here we're talking about is actually the money market fund, the enhanced liquidity fund, and the short duration bond fund. So these are our suite of liquidity and short dated product. I mentioned that we do manage quite a sizable Sing dollar fixed income book. So when we manage these products for our clients, it's a very complementary. It complements our existing work that we do for the institutional accounts. Yeah, maybe I hand over to Bertram first.
Thank you, Tochie.
Hi, good evening, everyone. Thanks, Nandini. I'm with Nikko Asset Management. So my name is Bertram. I'm with the Asian Fixed Income team. So within the Asian Fixed Income team out of Nikko Asset Management, we manage both local Singapore bond strategies. This is our short-term bond fund, which is can be hedged to SGD or USD or AUD, but this is short-term bond fund for this call is hedged to the Singapore dollar. and we invest in short duration bonds for this fund. This was incepted in 2000, really to provide attractive yields to investors and perform better than cash. At the same time, still maintain the sort of short term, short duration profile in a fixed income investment. Yeah, that's really for me. And we've been managing this fund for around 25 years now. Previously, it was under DBS Asset Management, and so now under Nikko since 2011.
Right. Thank you very much. So maybe Tuchie, to start with you, if you can just walk us through what are the basic principles of money market funds and some of the benefits that you consider that they provide for including them into a cash management strategy.
Right. So I'll be talking about mainly the money market fund and enhanced liquidity fund. So both funds are similar in the sense they are very short dated, very safe, and it provides daily liquidity. Now the fund buys into very safe single A rated products. So for example, we might buy into MAS bills, very short dated bonds issued by government or corporates. So right now, both funds are yielding around 3.2, 3.3%. Both funds are rated A+, and both funds are very liquid, right? Because we provide daily liquidity. We do not take a lot of credit risk, and therefore we have a single A, or rather A+ credit rating, right? That tells you how good the credits are for the bonds that we buy. Earlier on, Nandini mentioned that we have never had a single drawdown, and one of the key reasons is this. Now, because we buy very short dated and we buy very high quality assets, the trustees and auditors allow us to mark the bonds at this method called the amortized cost method, right? Meaning that, for example, right, if you buy let's say a 1-year bond at 4%, throughout the life of the bond, we are just marking the price such that the yield is always 4%, right? Think of it as let's say, placing a 6 months FD, right? And how would you mark this investment in 3 months' time, right? Basically, your investment will just accrue based on your yield, based on your interest earned every day until that point. So, but like I mentioned, because we are buying very high quality and very short dated instruments, the auditors and regulators allow us to mark the portfolio in this manner. And by doing so, when you buy this product, you will not have a drop in NAV because you're always accruing. So this is the testament to the safety and the attractiveness of such products. So these two are really our liquidity solutions, the money market fund and the enhanced liquidity fund.
And exactly to that reason why, usually we do consider that as the next best option from a fixed deposit. Actually, you could think about leaving the money in the portfolio exactly for that amount of time. But because, as Tochie said, because it is being accrued in the product itself, actually, even if something happens that that makes it that you must take the money out before. Usually in a traditional FD, you're going to lose all of your interest if you actually break that FD, which in this product, you actually don't. You just accrue up to the number of days that you have been in it. If you thought about a 6-month time frame, but even if you take it out in a 4-month time frame, you get the 4 months worth of accrual, and you don't have to have the same conditions as an FD. and with an enhanced yield. So it's really one of the reasons why in 2019 we launched this product in a low interest rate environment. Now becomes even more important in a high interest rate environment.
Yeah, that's
So,
right. I mean, I mean, you put up a very interesting or useful point there. You mentioned that, you put your money into FD. If you break your FD, you lose your interest. In the case of these funds, you don't. Now, the other comparison I want to highlight is if you have to buy a 6-month T-bill, right? And 3 months later, it's very hard for the retail investors to sell a T-bill. But in this case, you buy into these products, you can liquidate, straight away. So
yeah.
the same argument applies for T-bills.
Absolutely, absolutely. Thanks for that, Tochie. So, Bertram, if I can ask you to share a little bit around the basic principles of short duration bond funds and probably, what's called almost ultra short duration bond funds, and also how do you see the benefits of including them in a cash management strategy?
Okay, so for the short duration bond fund that we have, so the duration of the fund we actually maintain at least within 3 years. So a short duration in the last 3 to 5 years, we've been maintaining around 1 to 2 years for this fund. We only invest in bonds from close to 1 month up to 5 years. We don't invest in perpetual bonds, and currently our average duration is around 1.5 years. So the duration really is a measure of interest rate risk, of how volatile a bond or a bond portfolio can be. So for this one fund, which we only have around 1.5 years, that indicates a low interest rate risk. During the height of, in 2022, for example, during the height of the inflation risk, where you have interest rates rising quite sharply, we maintained a very low duration for this fund of around 1 year. And the other aspect is quality, which is investment grade. So all the bonds that we buy are of investment grade quality. So there's a very low probability of default. And we maintain an average credit rating of A minus for this fund.
Perfect. And again, the add-on, the way we see it in our product is really to say when you do know that you're not gonna need the money for 1 to 2 years, as you heard, the average duration is around 1.5 year. This is where moving a little bit of allocation from 100% money market funds to a 30% money, 20% money market, and the rest into short duration bond funds. That definitely helps to push the yield forward. But the 20% allocation also keeps, a little bit of volatility. So again, a management of volatility. So again, we try to, the way the portfolio is constructed is to ensure that the risk taken in the portfolio remains below what we would call appropriate for cash management, no matter whether your tenure that you're looking at is within 1 year, then fully into simple. But if you're looking at a tenure of over 1 year, then you actually can benefit from add-on short duration bond funds. So both of you spoke a little bit about the interest rate, and obviously, it would be great if you can help our listeners understand a little bit on, what is it that, how do interest rates impact the funds that you manage? So on the money market side, as well as on the short duration bond side, and what is the time frame that it takes for that interest rate change impact to actually filter through?
Right. I'll go first. I think at a very fundamental level, if we talk about bond mathematics, interest rates and price of bonds is inversely correlated. So if interest rate were to come down, bond price will go up. And of course, the opposite is true. Now, on the money market and enhanced liquidity, because our duration is so short, and because of the way we mark, there's no volatility in the fund. And how does interest rate affect these funds? In general, as interest rates goes up, the yield of the fund will go up, and therefore we have the price would accrue on a certain slope, right? And that slope is defined by the interest rate levels. So during the periods when interest rates were very low, the fund yields are low in reaction to that, and it would therefore accrete at the lower gradient, right? When interest rate goes up, you will then accrete faster. Now, this is for the money market and enhanced liquidity fund. For the short duration funds, because we are mark to market, then you do have the instantaneous reaction, right? So if interest rates were to move up, then straight away your bond price will react, in this case, negatively. And the opposite is true. So that's how interest rates affects the price, and the transmission mechanism. It's immediate for bonds that are for funds that are mark to market.
Right. So, Bertram, if I can ask you to share a little bit your views around, right now, what is happening in the markets. Obviously, there is high volatility in equities, but what is the impact that you are seeing on bonds, but also what is it that you are looking at very closely?
So for our short-term bond fund, there are a few factors that we look at. One is the interest rate levels. Chay has mentioned that if interest rates go up, then bond prices will go down. And if in the last since 2022, interest rates has been going down, and that's been positive for bond funds. We started with a high yields, and then since it's been going down, it's been positive for bond funds, including the funds that we manage. In the current scenario where it's been a mix of one, you have inflation concern with regards to tariffs, with regard to Trump's policy, that can be negative for bonds. And we saw that play out in Q4 last year when interest rates started to go up as the Trump administration is expected to come in. But in Q1, we saw interest rates go down again. And this month, we saw interest rates go down and then go up because of various factors. On our end, we really the volatility is leading us to would recommend to sort of like de-risk. So for investors, you want to avoid the interest rate volatility, then you go short duration. You want to avoid the higher probability of defaults or credit spreads widening, then you go into high quality. So I think this is where the role of short-term bond funds that we have is that you protect from interest rate volatility and also from credit risk. Always remember that these funds buy credits, they buy corporate bonds, we buy government-related bonds, and they do have additional yield or spreads over that of government bonds, but these spreads can widen during stress cases like what we're going through now, and so that's why we avoid high yield and really try to maintain a high quality portfolio in terms of credit as much as possible.
Okay.
Right. If I could add on, the recent, especially last week's volatility, you have seen US rates more volatile. And from that point of view, staying at home, staying in Sing dollar products does give you that additional safety. So you've seen some differentiation in rates performance, where US rates at the longer end, you have some sell-off, whereas Sing dollar rates are more stable. So from that point of view, our preference now is to look to buy into Sing dollar products. On top of that, we are very mindful of the hedging cost. So like I think in both Bertram and our funds, we don't have currency risk. But that would mean that we need to hedge our, let's say, our dollar bonds back to Sing dollar. And therein lies the hedging costs that we need to look out for. Again, with a very volatile environment, the hedging cost does swing around. So that's another thing we need to think about when we buy into non-Sing products. Now, at the same time, now this might sound contradictory, but because the hedging cost is so volatile, and because the bond market is more volatile, it could also mean that there are occasions where we can pick up bonds at the same high quality. We can still pick up bonds and find that the yield as a result of hedging it back to Sing still makes sense for us to buy. So, we do use these kind of environment to hunt for opportunities to take in that little bit more yield so that our funds yield can be higher. And the key thing here is we do not sacrifice on credit quality when we go about looking for these bonds.
Makes sense. Thanks for sharing that. And maybe as a continuation to it, we have in May, the next Fed meeting that is coming up. I think there is chatter between whether there would be a 25 bips cut or no cut. What is it that both of you are paying attention to in it, and how should our investors be thinking about the next cut coming in?
I think Bertram mentioned it earlier, right? That the impact of tariff, there are two impacts, right? One is inflation, at the same time, negative on growth. So in that aspect, Fed, the US central bank, is in a bind. They can't really quite do either way. And as a result, the best thing they can do is to wait and see. I think specifically they want to see the impact on tariff, on inflation. So I think for the May meeting, it's probably too soon for them to see any real feed through of such, let's say, inflation. And neither is market expecting Fed to do anything in May. So if anything, the first thing they'll do after the first reading, the next meeting will be in June. That's probably when they are inclined to pencil in one cut, and then after that, the follow on, you have the rest of the economic prints coming in, and then they'll evaluate. Bertram, I'm sure you have the same view.
Yeah, agree. There's a lot of uncertainty. We've seen that just in the last 1 to 2 weeks, and then the back and forth, all the
Since our last event, so much
Yeah.
news got created.
So we all thought that interest rates are going to go down with uncertainty, but you see U.S. interest rates go up. So there's a lot of this uncertainties in the market. So for the U.S. Fed market is pricing in around 3 to 4 cuts later this year. We're not sure if it's on May, but really I think because of all the uncertainties and how it will impact growth, how it will impact inflation, I think the Fed will have a difficult time. I mean, your guess is as good as mine, whether they will have to cut, because we won't even know what the tariff policies will be then. I mean, the trade war, you don't know whether it's over by then, so it's really difficult to do any prediction for now. But having said that, it's being priced in the market around 3 to 4 cuts, and you can see it in the short end part of the curve or the yields that you're seeing.
But having said that, I think over the near term, whether Fed moves or not, I think for both our funds, I don't think there'll be much impact, right? Because it's either our liquidity fund or short duration funds. We are not taking a lot of interest rate risk. So from that perspective, we're probably not as sensitive to Fed's action compared to other funds that's a lot more longer in duration.
So maybe a little bit going deeper into that as well, while we want to make sure that the cash that we want to keep very liquid, very low risk, money market funds and short duration bond funds can help with that. But as people think about that, okay, this is maybe money that I don't need for 5 years, 7 years, 10 years, but they still want to stay in fairly low risk profile. How would you recommend people to think about the duration of bond funds at this moment?
I think for now, I mean, given this environment we're in, I would be very mindful of taking too much duration risk. I think Bertrand mentioned that. I think what happened last week was pretty concerning. And by that, what I mean is that you have a situation where when you have risk asset sell-off, the investors were not seeking their taking safety in US government bond, right? So that does worry me a bit because it really changes whole regime of what it means for the US to be a risk-free assets. And we have seen long end, as in let's say the 10-year US yields moving up when you have the S&P dropping very sharply. So that part is concerning, and from that point of view, I'll be concerned to take any duration risk for now. I think short duration or money market funds, that's a good place to hide until this is over. Bertram?
Yeah, I think short duration bonds versus a long duration strategy, investors can have an option and see where they really believe it's going to be, or what kind of risk management they need, because in the end, short duration funds will just give you whatever the yields are without significant duration risk. But the thing is, some investors do like long duration because of the fact that it's really a hedge on the possibility of recession. So if there's a risk of recession and the Fed gonna be cutting aggressively, then that's the role of long duration bond funds, where they can perform much better during a recession scenario. So I think the role of short-term bond funds is a defensive, de-risking both duration and all the other volatilities. But the long duration strategy is really a risk of kind of recession kind of positioning, very defensive for a long duration strategy or government bonds. Yeah.
Okay. Before we go towards more the Q&A, could you both just share, how what is it that you see as challenges ahead, and what is it that you are preparing for in terms of how you manage your funds?
I think near term, the concern I have is, it goes back to this tariff thingy which Trump is unleashing to the world. If back to my point, right, when US is no longer a safe haven assets, if that really were to come to fruition, then I'll be concerned about how markets would de-risk, right? Because if your treasury rate is no longer a risk-free asset, what does it mean for valuation of let's say a stock? For now, that worst case scenario is not happening. But since you asked what worries me, it's a sell-off of, or rather, loss in confidence of US assets, right? Meaning, you sell off in US equities, US bonds, and US dollars. And whether or not this will lead to a credit crunch, right? But that's something we're mindful about. And I think Bertrand mentioned about de-risking. So that's something that we too are watching out very closely. Also trying to keep some of our powders dry to be prepared for any of such worst case scenario that could happen.
Yeah. From my end, we really are maintaining a very defensive stance for now, in terms of, given that we're investing in companies, we're investing in their bonds and their credit, and we really make sure and continue our bottom-up credit research and analysis, and ensuring that the companies and the sectors we're in are least affected by the tariffs. And if there's going to be secondary impacts, the credit quality will remain. And so that is really one of the important aspects of managing a bond portfolio, especially buying credits.
Okay. Great. I'm looking at questions that we may have. Let me just check. So we have a couple of short questions. The first one being, does it make sense to hold more cash during this period of increased volatility? I have a perspective, but what's your
The fund's
perspective?
perspective or the individual's perspective?
No, I mean, maybe you are a seasoned investor, Tochi, so maybe also your personal perspective would be great.
Okay, maybe I'll talk about from the fund's perspective first. Both our funds, we provide daily liquidity, right? So at any point in time, we need to hold cash because to facilitate subscription and redemption.
Mhm.
And at times like this, for us, we do want to keep a bit higher level of cash to meet any requirement for redemption. But at the same time, it's also a balancing act because holding too much cash has a drag on the performance, right? If I put cash today with the bank, I mean, the fund keeps cash with the bank. Our overnight rates is probably around 2.3%. Now the fund's yield is above 3%. So having too much cash will be a drag, right? So like I said, it's balancing act, but right now we want to raise a bit more cash.
Yeah, from a personal finance perspective, it's very, I would mirror exactly the same, that, it's about cash that you do not need. If your needs of cash in the short term have not changed, then exactly to Tochie's point, if you're leaving even more money in cash, even if you put it into simple, it's actually against what you could have earned in a more balanced portfolio, even if you are in a 60/40 or in an 80/20 portfolio, because your time horizon over there is 10, 15 years. So again, everything is about for how long you are leaving a part of money in a certain profile, and whether that is out of a true need versus, actually your need is still in the same 10 to 15 year time frame. Then just like management of the fund, you're actually losing out on the yield. Maybe Toche thinks about it in days, and we think about it more in months and and years. But everything has a accumulation impact. Maybe, but one more question I have over here is, because the Simple Plus portfolio has short duration bond funds, is there a recommended time period of hold? We today say 12 months at a minimum. I think we match it as very closely to what the overall profile of the portfolio is. And as you said, yours is 1.5 year on an average. Would you think about the recommended period changing or yeah?
I think the 1 year period is sort of like at least ideal. But if you do have a view that interest rates are going down in the next 6 months, and that's your view, then you can use it to say, okay, but that's an active play. But overall, if it's a cash that you think, I think 1 year is fine. That's also reflects the underlying duration of the bond fund, which in a sense, although prices of the bonds may go up and down during that period, the coupons that these bonds will receive will be offsetting whatever price changes there are in the underlying bond holdings. Because this is like, clipping coupons, and then when they mature, you reinvest.
Yeah.
Maybe I just add a point to Bertram's point. And really, this is bond mathematics. Imagine, buying into our short duration bond fund. It's like buying a 2-year bond, right? And your question is about what's your horizon? If you think about how long do you need to hold such that you have very little chance of losing money, you'll find that the answer is probably, in that 9 months to 12 months. And beyond that, you should definitely not lose money, right? And this is really bond mathematics, because you have a 2-year bond. After end of 1 year, you have collected 1 year's of coupon.
Yeah.
You would need interest rate to move a lot against you for you to lose money as a whole, right? So So yeah, I would think that, recommended holding period would be around 12 months.
Yeah, I hold my emergency fund in Simple Plus, as well as my accumulation towards SRS all throughout the year, because it's one way to make sure that I'm not losing out on the interest on the coupons that can be collected over that 1 year time. Um, the next question is, when should I start increasing my bond duration from short to more long? What signs should I look out for?
But for example, from our end, we really have to wait for when there's greater clarity on when the tariff landscape is. I mean, but then that may not come for the next few weeks or even months. But I think you go long duration when it's really clear that the economic indicators in terms of growth, in terms of labor unemployment in the U.S., and it's really clear that the U.S. monetary policy will be on an easing mode, like a recession probability is high. I think that's when you increase duration.
Yeah, I think you look at what the Fed's mandate is really in inflation and employment. Or to put it another way, right? You want to extend duration when you think that you think that the US economy is going to go down, going to go into recession, and on top of that, there's no inflation. That's the best combination. But unfortunately, right now we are not
It's
in
not
that.
easy.
You have recession at the same time you have inflation because of tariff.
Yeah.
Right. So until the inflation risk goes away, then it's all clear. As of now, no, I
You have
don't
to
think
wait.
we're there.
Okay. There's another question about, is holding short-term bonds a better defensive position instead of investing in gold in the current environment? How do you see bonds and gold?
Which I
To answer that, I mean, gold has
played its role.
it's been very useful. And you've seen how gold has performed recently. So, I mean, gold acts as a good diversifier, but at the same time, I won't equate the two as a key part of the portfolio. Certainly, from a allocation point of view, a larger part should be in fixed income, should be in bonds rather than gold. Typically portfolios, maybe they put maybe 5% or the most 10% of the allocation into gold. So it's not the question of whether do you buy gold instead of bonds or the other way around, right? It's about portfolio allocation. Institutional investors, like I said, they tend to allocate some into gold.
Yeah. In fact, in our own long-term portfolios, which we call general investing portfolios, we have across all risk levels that we provide. We do have a gold allocation, and we've had it since day one. And it usually differs, goes from between 4% to 9% as a total. So exactly to your point, Tucci, which is, it's not about should you have bond or should you have gold, one or the other, but really looking at how to utilize both of the assets equally. And that's why we in fact, in Stashaway, our own managed portfolios have a construct of equities, bonds, and gold. With the gold allocation fluctuating between 4 to 9%, depending on the risk levels, but also depending on the economic regime where we are, which is entirely on inflation and growth and the direction of travel of the both. Bertram, your last thoughts on gold and bonds?
I mean, they do have a role for portfolios. Both of them can be together in a portfolio. Just to caveat that gold can be expensive right now, and then it's also a more volatile asset class. Just comparing, our short-term bond funds have a volatility of 1 to 2%. Gold's probably more volatile, much more volatile than that. So I think just to have it in mind, it's a defensive asset class from a performance perspective, but it's a volatile asset class.
Okay, I have one other question that has come in, which is, do you see USD depreciating or appreciating in the next 6 months? I'm deciding on investing between the USD cash yield, so the USD Treasury bonds, versus the Simple Plus, which is with the short duration bonds. So between more going towards SGD and or kind of non-US bonds being safer in the medium term. How do you see the role of USD playing over here?
I think at the fund level, we don't take currency risk. And really because currency is so volatile. So to be honest, it's quite hard to answer that question. We don't take currency risk in the portfolio because we take 1 year to earn that 3%. You can lose that 3% in currency in
Yeah.
2 days, right? So from that point of view, it's very hard to make a currency call. What I would say, what I would highlight is that dollar in the last, ever since Liberation Day, dollar has been dropping. And it doesn't seem to play its traditional role where US assets, or rather, investors seek safety in US assets. That has not been the case since Liberation Day. Of course, the conspiracy theories out there is, the Chinese and Japanese are selling US treasuries and selling the dollars. So that has a lot of implications on financial markets. But I must say, it's very hard for us to give a currency prediction like that.
I think from a personal finance perspective, the advice that we give is, on a short duration, like 6 months, whatever your needs may be. If your needs are in the Singapore dollar, in the local currency, then this is too short a time for you to add, as Suchi said, currency risk to it. If you are actually looking for a goal where you are meant to spend in US dollar, then obviously, you can take advantage of the currency movements and accumulate, your funds accordingly in the currency and let it grow in that currency appropriately, because actually your end result, in 6 months or in 1 year, is actually spending in that currency. So beyond that, 6 months is quite a short time to take on currency risk. I believe, yeah. We have a few questions which are more, I think, product related. So there's a question from YouTube, which is, I would like to know the lock-in price, whether it is on the day we submit or the day it's reflected in our account. I believe you are referring to simple guaranteed. So the lock-in price is the price that you will see when you are locking in the fund. That's actually the rate that you are guaranteed. Second question we have from YouTube is, will any new portfolio be formulated that is resilient and tariff-proof for investors? And also if there will be any new ETFs under ethical investing, Sharia compliance, which can act as a hedge. We do have some ethical investing ETFs on our platform. They are under flexible portfolios. Please do reach out to our client engagement team, who would be happy to take you through them. There are sukuks on the platform. But maybe coming back to, I wouldn't say from a new portfolio to be formulated that is resilient and tariff proof for investors, but maybe Bertram and Toche, do you have comments around what you consider today, resilient and tariff proof for investors? And then I'm happy to share a more personal finance view on this.
The money market funds are tariff proof because the price doesn't change.
If you want absolute proof, but remember your tenure, yes. But
everything else is everything, right? From FX, equity, credit, they all have been affected. So There's no running away, actually, unfortunately. I mean, the other way is to manage your risk. So our short duration bond funds, both Bertram and mine, to some extent, they are less risky than the other longer dated bond funds. So from that point of view, yeah, it's probably on a relative basis better.
Bertram, for
Yeah,
you.
I agree. It's all about the risking for now, and these are one of the lower risk strategies that's available for investors without really losing in terms of yield or potential returns. Not really staying in deposits. Yeah, it's the safest, but that would be minimal returns.
Yeah, I mean, look, from a personal finance perspective, globally diversified portfolios, if you're looking at the long term, and this is why we know there are times when the US market is really rallying, and it might seem that, oh, if you had all of your funds in S&P 500, it would have done so well. But there are other years where it has much higher volatility as well, and that's just part of wealth building over 25, 30 years, right? There is no way to escape the volatility. Some fundamental truths that always remain true is that a good diversified portfolio means that there are asset classes and sub-asset classes, geographies, sectors in it that are not always closely correlated, and therefore they provide that diversification impact and weathering it, which, if you compare it 1 year to the next with a pure S&P 500, it might not show you as much return, but cumulatively keeping you invested because it manages your volatility better, and therefore you are not exposing yourself to a risk level that suddenly in a year you might find out that actually that isn't the risk level you are willing to stomach. That can be quite a hit on your overall wealth building journey. But usually, we like to tell people that over a 30-year wealth building time frame, you will go through at least 5 to 6 bear markets. I've gone through quasi 4 now in my own life, and you will go through at least 20 to 25 market corrections. They happen more often, and that's just normal. And every time we think, oh, this is a different time, but when you zoom out to a little bit of a bigger picture, the end impact is exactly the same. It's volatility. It's better stomached by a globally diversified portfolio, and making sure that you have a very clear cash management strategy so that the money that you need over the next 1 year till the markets settle and all, you are actually not having to make drastic life choices. And I think that's why we pay so much attention to, advocating not to leave too much money in a low yield savings account. With that, Tochie and Bertram, I'd like to thank you for joining us again. I know 2 weeks ago we did the same topic in our office. It was such an amazing success. We had a lot of people write in, which is why very quickly we wanted to do this at least as a webinar. So thank you so much for making the time again. We might have to come back to you to ask again for your time in a little while, but you're always very generous with your time, and we are very, very grateful for it.
It's our pleasure, Nandini.
Thank you. It's our pleasure.
Yeah. And thanks everybody for joining in. And if you have any other questions, please feel free to reach out to our client engagement team. We're always happy to answer via phone, email, or WhatsApp, any method that you prefer. With that, thanks for spending your Monday evening with us, and good night.
Thank you.
Thank you. Bye.
Thank you.
Bye.